Hey, traders. Welcome to another lesson here at Trading Club 7U. Today, we're going to tackle a critical concept in technical analysis that can help you understand the bigger picture and make more informed trading decisions. Have you ever felt overwhelmed by the sheer volume of data and price movements in the markets? Do you struggle to make sense of the numbers and charts? Well, you're not alone. Many traders struggle to grasp the concepts that can make them successful, but today, we're going to break down the concept of VWAP, or Volume Weighted Average Price, and how it relates to institutional price context. So, what is VWAP? VWAP is a measure of the average price at which a security trades during a given period of time. It's calculated by adding up the total value of all trades for that period and dividing it by the total volume. Think of it like a running average of all the trades that have taken place during that time. For example, if you have a stock that trades 100 shares at 50, then 200 shares at 55, and finally 150 shares at 50, the VWAP would be the average price at which all these trades took place. Let's do a more detailed calculation to illustrate how VWAP is calculated in practice. Let's say the total value of trades is calculated by multiplying the price of each trade by its corresponding volume. For example, if you have the following trades: 100 shares at 50, 200 shares at 55, and 150 shares at 50, the total value would be 100 shares 50, 200 shares 55, 150 shares 50, which equals 5,000, 11,000, 7,500, or a total value of 23,500. If the total volume is 500 shares, the VWAP would be the total value 23,500 divided by the total volume 500 shares, which equals approximately 47. However, what if we don't just use the prices and volumes directly like this, and instead consider how much volume has traded at each price level? This is exactly what the volume weighted average price VWAP does. It gives more weight to the trades at higher price levels as well. A more practical way of thinking about it is that, if a lot of volume has traded at a particular price, it indicates that's the price at which most traders have entered the market, and if the current price has deviated significantly from that price, then the price may be due for a correction. Now, you might be wondering why VWAP matters. Well, it's because institutional investors, like pension funds and hedge funds, often use VWAP to determine their trading decisions. They know that by taking a large position in a security, they can influence the price movement, but they also need to make sure they are buying or selling at a favorable price. That's where VWAP comes in. By understanding the current VWAP, these institutions can gauge whether the price is deviating from its average and make decisions accordingly. However, there are common beginner mistakes to watch out for. One of the most critical errors is not considering the time frame of the VWAP calculation. For example, if you're looking at a 5-minute chart, the VWAP might be skewed by one or two large trades. To avoid this, make sure to calculate the VWAP over a longer period, such as 30 minutes or 1 hour. You can do this by simply increasing the time period being observed. Another mistake is not paying attention to the volume that has traded at the current price level. Remember, VWAP is a weighted average, and if volume is sparse at a particular price level, that price level may not be as significant as it seems. To make a more informed trading decision, use this information to analyze the current price levels to determine potential support and resistance levels. If the current price level is higher than the VWAP, then it may be a sign that the current price is being driven by weak hands buyers who bought too high and may need to sell quickly to cut losses. Conversely, if the current price level is lower than the VWAP, then it may be a sign that the current price is being driven by strong hands sellers who are selling at a higher price than they bought and are therefore likely to continue selling until they are out of their positions. So, Here's your homework exercise for this lesson. Open a chart of a stock you're familiar with, and plot the VWAP over the last hour. Then, calculate the average price at which the stock has traded over the last hour using a simple running average calculation. Remember to take into account the total volume traded during that time period. You can use the following formula: sum price volume. Compare your result with the actual VWAP plotted on the chart, and observe any deviation. Risk warning: trading carries significant risk, and there